Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent CPI report. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, we had the headline inflation rate come in just yesterday at about 2.38%, so rounded up to 2.4%. It did go up slightly from the last month. I believe consensus expectations was that it would go back up to 2.5%, so it actually came in better than expected. What's interesting is that despite the fact that inflation continues to trend in the right direction, you can see that the Fed doesn't really seem all that interested or amused, and the next rate cut, at least by CME Group, is not expected until September. There's a small chance, maybe a 23% chance they'll cut in July, but the meeting that we're going to have next week, there's only about a 3% chance they're actually going to cut rates. So, if you guys remember last year, September was when they cut interest rates for the first time. Kind of seems likely that they're just going to follow it up with another rate cut this September. And it could be on the back of, a rising unemployment rate or something as we go through the summer. Because, in the summertime, we see initial claims go higher. Last couple of years, we saw the unemployment rate tick higher a little bit. So maybe you get a couple, 2 to 3 higher unemployment rate prints. You'll probably get a few more rate cuts. But what's interesting is that inflation, continues to just slowly trend down. The disinflationary trend continues. I've always been a big believer in this disinflationary trend. I think that tariffs make me not as confident as I once was, but I do think if there is a rise in inflation due to tariffs, I think it will be relatively short-lived, right? It might just spike and keep the Fed from cutting a little bit longer, but the fact that, we've had tariffs in place for a little while now, and we, back in April, you would have expected to have seen some of that show up in May, which is what we just got the data for, but we're really still not seeing a whole lot of that. One of the ideas too that we talked about is that, and I don't know if we're there yet, but at some point, higher prices, the consumer will just say no, and then that's when it becomes, difficult for businesses to pass on the higher prices to consumers, right? The consumer just gets tapped out and they're like, well, enough is enough. We're not going to continue to pay these higher prices. And then businesses are forced, to stop raising prices so much, which of course eventually affects earnings. It's really hard to say if we've reached that point, but the disinflationary trend more or less continues. I mean, technically speaking, inflation went up, but it is still very much, it's very much been heading in the downward direction. If you look at like a 7-month moving average, I mean, it does just continue to slowly drop, right? If you look at it today, if we go back to today, the inflation rate is 2.38%. A year ago, in May of 2024, it was 3.24. In May of 2023, it was 4.13. And then, of course, in May of 2022, it was 8.53. So it is still moving in the right direction. Now, of course, it makes sense to look at inflation year over year per category. So we're just going to quickly do that here. And we'll zoom in. This is not contributions because they're all weighted differently. But here you can see headline inflation, food and beverage inflation has actually went up a little bit. So that could be part of the reason why we saw inflation go up. Housing also stayed constant. Housing, again, makes up a big component of CPI. So the fact that it stayed constant allowed inflation a little bit more room to move up if any of the other categories were down. But if you look at apparel, it actually became even more deflationary than it was. Transportation was also deflationary as well. It seems to be a little bit more common with transportation. When you look at apparel, while it does go deflationary some, it doesn't do it as frequently as transportation does. And then if you go to medical care, it's starting to come back down from 2.74 to 2.48. And then recreation, actually, I believe it increased a little bit from 1.59 to 1.8, still 2%, so it's fine. And then, of course, education and communication is still well below 2%. And then finally, other goods and services actually increased from 3.57 to 3.82. So I'd like to see that one go a little bit further down. But if you look at the contributions per category, you can really see that so much of the inflation, right? If we look at headline inflation and then we overlay housing, so much of the inflation is just coming from the housing market, right? So if housing inflation were to continue to drop, which seems like we might see house prices potentially roll over some, especially if the long yield curve goes higher. You can see if housing inflation were to go down, it would likely cause overall inflation to go down just because it's such a big contribution to overall headline CPI. Food and beverages affects it a little bit, but not nearly as much as housing, right? So if you have headline inflation here and then you have food and beverage, it's not nearly as much as housing. Although housing and food and beverages are two of the biggest categories in terms of contributions. You can see apparel doesn't really have a big effect. Transportation, not a super big effect. I mean, again, this month it actually caused it to drop some, so that's a good thing. Medical care, pretty small effect. Recreation, pretty low. Education, pretty low. And then other goods and services, also pretty low. So once again, it's primarily driven by housing. I mean, housing and then food and beverages account for most of it. I mean, look, like this orange bar right here, that is headline inflation, and then these two categories make up most of it. I mean, obviously, there's a little bit more excess because some of the categories were deflationary. Therefore, there were a couple other categories that, made up for that. But you can see that just those two categories has given you a pretty good estimate of headline CPI the last few months. Now, that wasn't necessarily true in 2021 and 2022, but in recent months, those have been the primary categories to watch. And then finally, if we look at core inflation, it actually continues to drop, right? So a few months ago, it fell from above 3% down to the 2.81 and then 2.78. And then this month it came in at 2.77. So the monthly change is still negative. It's good to see that core inflation is continuing to trend down. And my guess is that it will continue to trend down. You might have a spike at some point due to tariffs, but I think it would be somewhat short-lived. I still remain in the disinflationary camp. If you guys remember a few months ago, a lot of people were talking about the comparison to the 1970s. And again, while there could be a future spike, I don't think we're going to see the exact same, inflationary wave. It's not my base case as of now, although again, the tariffs do make it a little bit more complicated than it once was, right? I mean, again, the easy thing for so long was just to be in the disinflationary camp, that it would be a stochastic process, but that we would see disinflation primarily driven by the fact that interest rates were going to stay high for longer, and we were just going to see tighter monetary policy that would again slowly reduce overall in inflation, where they tried to slow down demand, and that's what they've done, right? It's just the tariffs leave a question mark on things, and I guess the issue that we sort of have to face is that there's a chance that had tariffs not been a thing, they would have already cut rates again. And they always say how like the Fed's too late to everything. There is part of me, especially as we go into the midterm year 2026, a lot of times, at least for crypto, midterm years aren't really that great. It does make me wonder, what are the chances that the Fed being worried about tariff inflation, whether it actually comes to pass or not, whether it has an effect or not, could it be that they worry about it and it causes them not to cut when in fact they should be cutting? And I think that's the biggest thing to consider here, is maybe they're going to hold out too long or longer than they otherwise would have just because of tariffs. And so it makes you wonder, like, would we have already had more rate cuts at this point? But, as far as I can tell, I haven't seen anything to indicate that the Fed will cut in June. Not a lot of indication that they're going to cut in July either. So I think for now, the base case should just simply be September. That was when they cut last year. And it would also be kind of after potentially a couple months of higher than wanted unemployment rates. Again, we also saw continuing claims come in today higher than they have all cycle. Initial claims are still pretty high, but still not at that 300,000 threshold, which is where I think it would ultimately need to be recessionary. So that's where we are right now. That's your CPI report. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.